that contrary to what people tell you, that you have to have your MBA and life figured out by the time you're 25. No, you don't. I would say that education is really, 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 really valuable. And then you got to be able to apply it. So I think that is, don't let other people set your norms for you. And I think a lot of people are that way. Find your own path.
From cornfields to high rises, office to industrial, houses to hotels, and every other asset class in real estate, we cover the people, the projects, and the profit. Welcome to the Investing in Iowa show. This show is for go-doers, action takers, and business owners. It's for people like you who are sick of Uncle Sam taking a huge bite of your apple. If you're looking to get ahead of what's taking place in Iowa, learn who is doing what, and how you can get in on the action, you're in the right place. Hosted by Neil Timmins, an Iowa native who has been involved in over $300 million in real estate right here in Iowa. Recording in studio from West Des Moines. Here's your host, Neil Timmins.
I've got Larry Wolf here on the show. Larry, welcome.
Afternoon, sir. How are you?
I'm doing terrific. It's good to have you here. Say, for the audience's sake, who are you? Where are you from? What do you do?
Well, that's a mouthful. Right now, I am from Eldora, Iowa, and I'm retired. But originally, I am from West Central Illinois. I came to Iowa and as part of employment with a bank, and I have been, amongst other things, a banker, involved in banking for 40 years. Grew up in a family that was involved in real estate, insurance, and banking. My father was a broker, mortgage broker for a number of insurance companies for ag and commercial loans, institutional property manager, railroads, hospitals, small private colleges, that type of thing. So I was riding shotgun in his pickup truck by the time I was 5, and I just grew up in it.
It sounds like, given that background, a man who wore many hats and has seen many things. How did you end up in Iowa?
The paycheck.
Yeah.
It's, as they say, it's not what you know, it's who you know. My grandfather's neighbor's nephew was the president of a bank in Illinois, and I talked to him, and he said, you'll hate my bank, but my son-in-law is looking for a lender at a bank in Iowa, and you'll love that bank. And I stayed there 31 years.
31 years. So you moved to Eldora, Iowa. Did you know anybody in and around Eldora, Iowa when you moved?
No one whatsoever.
Yeah. What was that like early on? In bank? What, remind me, was 89? Was that the year?
93.
93. Thank you. And so what was that like to move here? And then what was the environment like in that time frame?
It wasn't really that different. I mean, Eldora is a carbon copy. A town I grew up in, Illinois, is Midwest agricultural and manufacturing town. Number of factories there. I moved to Eldora. Eldora was a Midwest agriculture and manufacturing town. I think at one time there was close to 700 jobs in the industrial park out there. So, other than being a stranger in a strange land, it wasn't traumatic. I don't think I was scarred by it for life. But I did actually, I came, and no one knew. If you remember, 93 was the floods.
Right.
And I was actually out here. I was in Des Moines in July at the peak of the worst of the floods, and then came out here in September. And no one knew how severe the crop damage and yield loss was until... And I came out here about the 20th, 21st to be exact. And the Farm Progress show started about a week later, 1st of October. And our eyes, I walked into a crisis. 93 in Iowa with the floods was one of the worst years they had in agriculture in probably the last 85.
Oh.
But, it was just a crisis. So walked into a buzzsaw without knowing it. But I'm coming from a farm background, grew up on a farm. So that's what we did for a year or 2 years, was try to save businesses.
So you did that for a couple of years, work your way through that, and then what type of assets and what geographic locations were you lending?
At that time, it was pretty much central Iowa, and I was doing a combination of working with the ag customers, and then, like I said, also At that time, Eldora had a number of manufacturers and some processing. So I was, as well as doing on the ag side, working with plastics manufacturers, chemical manufacturers, processing ag and feed and that type of thing, processing wholesale distributors, just you name it. The one thing the bank never pigeonholed itself. It's, at that time, it's the true definition of a community bank. Our community had those needs for financing. Like I said, everything from seed corn plants to plastics, injection blow molding, a lawn and garden wholesale distributor that covered most of the Midwest. So there was a business that needed financing. We did it.
Wow. Not just a business, I suspect. Probably a fair bit of commercial real estate.
What's that?
I've said not just a business, but also a fair bit of commercial real estate.
Yeah, so that's actually came a little later, about 90, 97, 98. The bank, and I'd always been around real estate, but it wasn't, there's not a large number of apartment complexes in Eldora, Iowa. I had the town I grew up in Illinois, just 15 miles from where Western Illinois University is, not far from Galesburg, not far from Burlington. So I had been involved with commercial real estate. Bank needed to grow, and rural Iowa was not growing. So we branched out, moved in, working with other banks in Des Moines, Waterloo, Cedar Rapids, Knoxville, Newton, and then ended up in the Minneapolis market, and then through connections ended up in the Rockford and Chicago market in the early 2000s.
Direct lending, or were you participation?
Both.
So you got to learn a whole bunch of markets and then multiple asset classes as well.
Yes.
Yeah. So through the early 2000s, what was that like? Because it seems like that probably a lot to take on and swallow, multiple markets, multiple asset classes, and then now you're in commercial real estate more heavily versus financing of businesses.
There's a learning curve. I came from the background of, one of the things that on the insurance companies that my father was a mortgage broker for, big in hotels and malls in the early and mid 70s. So I grew up around malls and hotels, and that's what at that point there was a lot of, and also around apartment buildings and rentals, both single and multi, but things cross over, things transition. A door's a door. Now, whether that door opens into an apartment building that's down the road from a university, or whether that door opens up to a senior living apartment, a door is a door. And that's where it starts. And depending on the lingo and the mindset, it crosses over. And the same thing with whether you're doing malls or office buildings and enclosed malls, strip malls, or office buildings. A square foot's a square foot. And 1 point of vacancy, 1 point of vacancy.
Sure.
So it's not rocket science. We'd like you to believe that, but it's not.
Well, when you underwrite, let's say, you underwrite a deal, and I'll come off that. When you underwrite a person, what is it that you're looking for there?
Well, you're looking for two things. You're looking someone with some financial wherewithal, obviously. And the big thing is, they talk about it's the C's of credit. It's character. It's character. Went through some very unpleasant times from starting in 2007, and that didn't clean itself up until, people don't realize how long it takes to get out of a crisis. But it was 2015 before we closed the file on the last problem. And I can tell you that it's all about character. That's what it is.
Well, going through that Great Recession, knowing it's all about character, what did you learn from that period and having challenges that you applied to future lending?
Two things, and not learned, but reinforced, that if you make good loans to good people and times get bad, you'll survive. Now, not saying you'll survive without a hiccup or a hickey, but you will survive. If you do good loans with bad people, you just as well look through the manhole cover and throw your money down the sewer. The other thing is, and I think that we saw that with what happened with the crash and the crisis, and the infamous words of, I think it was Mr. Greenspan, who said, irrational exuberance. No, they're not making any more dirt, but there's times when there's more than what people need. And I think one of the biggest one of my sayings is plan for the worst and hope for the best. Always shock your proposal and your plan, whatever it is, whether you're building um, a storage, self storage unit, or whether you're building high rise condos, always shock your plan. Because one of the things we looked at a particular plan building in Florida condos, vacation rentals, and at that time, I think it still does, the retirement pension plans in the UK and Germany and I think Sweden, I don't know how many European countries, you can invest in real estate self-directed in your pension plan. So, especially the Germans and the Brits were coming and buying vacation rentals in Florida, close to Disney, close to Miami, South Beach, whatever. And they were putting 30% down. So we're financing condos on the beach in Florida. And you said nobody will ever walk away from a 30% down payment. We never got beyond pouring the footers.
Wow.
Yeah. And luckily that was their money.
Sure.
But that's things don't say that this can't happen. It will never happen again. They're never making any more. That's what overly optimistic irrational exuberance. That's you have to keep a check on your emotion and your desire, and you have to shock every plan from every angle. And like I said, plan for the worst, hope for the best.
So walking forward, you've seen a lot of real estate investors, get it right. You've seen real estate investors, get it wrong, and or whether it's them in a project or maybe them how they operate in an environment. The people who get it right, what do they have in common? And the people who get it wrong, what do they have in common?
The people that get it right are deliberate for the most part. They're focused and they, with some exceptions, and again, we go back to that reality. What a concept. You have to be grounded in reality and focused. And shall I say, bravado takes a lot of people down.
Mm.
Stay humble, sir.
Oh, yeah. The ego.
Ego. Yeah. Stay humble, stay focused. So that is, I think a big part of it is that I watched a lot. The bigger they are, the harder they fall. And like I said, from 2007 through, through 10 and 12, 10 to 12 it was still very active. Like I said, it was 15 for some of the things got cleaned up. There are still, but I digress. But there are still private equity firms holding distressed real estate, basically in Texas, that they bought in 2010, 2000, still building it out. They're still building houses and strip malls on failed projects from 15 years ago. So, that's opportunity, that's patience, that's focus.
Yes. Well, and I think I have observed that a lot of these projects are real easy to get into and much harder to get out of.
Yeah.
You've got to be patient.
You have to be patient, and obviously somebody took a big hit there. When a private equity firm comes in and can afford to set on a 700 or a 700 watt development for 10 years before they start building houses,
right? Somebody
took a hit. And that's what I'm saying is somebody should have been smart enough not to start a 700 lot development on the southwest side of Fort Worth, Dallas, Fort Worth in 2005. It wasn't feasible with grandiose. It was ego.
Yeah. Well, anybody can make anything look good. I say in the sheets, right? On Excel. Yeah. How do when you get a deal like that, it's one thing to buy an existing property. These are the data points are that of what actually transpired. They're factual points of history. But when you got a straight spec deal, whether it's a ground up deal, you're doing the development, you're going to sell the lots, or whether you're going to go build 2 blocks of spec homes. How is that interpreted from the bank? How do you underwrite that type of thing? What are you looking for there? Is that the type of things banks lean away from?
It depends on the bank. It depends on the project. It depends on the borrower. Personally, I do lean into that, but I keep my angle of lean pretty well reined in. I'm not a big fan of construction lending, spec house, new development. Depends. Not saying that I don't do it with the right customer in the right market with the right research. But that is the problem with when if I'm going to do 30 a 36 lot development in um, Gainesville, Wisconsin, with the right developer, they can call me in August. We can call the appraisers. We can do the studies. They'll have that thing graded and pop it in foundations before the frost gets too deep to pop in foundations. If you're going to do 130 lots outside of Waukee, that's not a 3-month project. That's a 3-year project. And that is the one thing that I think that if anything, once burned, twice shy, and avoid the flame and the frying pan. Things that take no one's crystal balls, mine aren't any good. I mean, we can look at forecasts, we can do economic studies, we can do demand studies, everything. You can't be a fortune teller all the time. And our economy, I think, has gotten will be getting a little more volatile. We just went through this long period from 2010 to 2021. It just didn't move.
Right.
Um, and demand was not great, but it was there. So with reasonable expectations, you could do developments. But to get to the point when I enter a project that it's going to take 3 years, we're going to buy 160 acres now, and it's going to take us 9 months to get through zoning and city council. And then we're going to bring in the dozers and the track hoes and the excavators, and then.
Yep.
And the other thing, and we didn't expect to see this in Des Moines. I saw this in some bigger markets like outside of Salt Lake City and down around Little Rock in 2007, 2008. We have D.R. Horton in Des Moines now.
Right.
And D.R. Horton doesn't care. They move product. And if they have to move that product at a loss, they move it at a loss. We're building $450,000 starter homes, Acme Construction, with my 10-man crew. And I bought 30 lots. And across the street is D.R. Horton. And they have 10-man crews on 130 lots. And if they have to drop the price, we got 370 in this $450,000 house. And all of a sudden we got to sell it for 380. They'll do it. Acme has got a problem. They just got their direct cost back, but they're not covering their overhead. Then you have an issue. And we had until a couple years ago, we didn't have the force of a D.R. Horton coming in that could drive prices the way they can.
They can drive prices the way they can, and they also have the sustaining power better than any builder. They operate in all cash. So their ability to sustain, through all types of weather is with certainty because they operate in cash.
And they make a mistake. They don't wring their hands and hold on. They just say, well, this is the reality of the situation. We got to take a loss, and we got to take it now. First loss is the best loss, and D.R. Horton knows when to take a loss.
Yeah. Where we were going earlier, I agree with exactly what you just said, is nobody's got a crystal ball, and ultimately, if you live by it, you're going to eat glass, is because that time frame to project out, past a year, into 2 years, into 3, into 5, is impossible. You really just don't know where it is. And I suspect as a result of that, on the lending side, you end up more conservative. And then I have to suspect as an equity investor, you're going to go into a development like that. Got to be swinging for some very attractive returns in order to part with your dollars to go play in that kind of time frame with that kind of risk and uncertainty.
Right. Well, I guess the example, and having been, the ag crisis and the savings and loan crisis of the 80s, and then the crash of 2008, I can tell you that in January of 2007, I got an appraisal and feasibility study on a 150 plus unit apartment building out in what would now be the Jordan Creek area. Not quite there, we're approaching. The appraisal literally said, slam dunk, no brainer, you can't build them fast enough. It's the golden era, the new plateau, whatever you want to call it. I've heard those terms so many times in the last 50 years. But 11 months later, I was in court in my first foreclosure. By November 2007, I'm foreclosing on Jordan Creek project. So you went from January of a very well respected appraiser, nationally known, said you can't build them fast enough. It's a slam dunk, no brainer. Circling the lawyers. Now it wasn't the same development, but that development did not succeed. That 150 unit
Mhm.
apartment building cost somebody, not me, a whole lot of money.
Yeah. Wow. What are the biggest lessons you learned over the last 30 some odd years in banking?
I would say, and anyway, I keep repeating that, but the shock, the reality, the grounding to always say, okay, I go 10% over budget. My projected vacancy isn't 7%. We end up at 11. Shock every facet of your cash flow, income and expenses. I said, plan for the worst, pray for the best. And the other thing is that bad things happen to good people, and you never know how that's going to shake out. I mean, I said if you make good loans to good people, you'll use them. Every once in a while, somebody will surprise you. So you always, it's, as I said, it's character, character, character. But from the perspective of both the borrower and the lender, or maybe I say that both the lender and the borrower, you have to look upside down, backwards, forwards, inside out. You have to look at the cash flow, the potential pro forma income statement, and you have to look at the potential volatility of the value of your hard asset.
I was
Okay.
I was talking to a house flipper last week, and he said something to me, which was, "I've never had a project come in under budget." And I'm like, "Yeah, I totally get it." So yeah, well, you're headed down that path is to go, okay, cool, you got a budget, now go shock it. What's it going to do when you go over budget, knowing
Yeah.
that almost never is that thing coming in under budget?
No, it just doesn't happen. Well, I wouldn't. I've been told by some people that they brought a project in under budget. I've never actually seen one.
That's probably like the fish right at the lake.
Yeah. No, I've been told if you dance naked counterclockwise at the height of the full moon, that the fairies come out too.
Hey, Iowa investors, this is Ava Baukamp, Chief of Staff at Legacy Impact Investors. Have you thought about adding real estate to your portfolio but don't have the time or desire to play landlord? At Legacy Impact Investors, we do the heavy lifting. Our team finds the deals, manages the properties, and handles all the day-to-day operations. Our select group of qualified investors co-invest with us, gaining ownership equity without opening a tenant email or responding to a maintenance call. They just share in the income, appreciation, and tax benefits. These opportunities aren't for everyone. They are for qualified, accredited investors only. If you want to learn more, please visit legacyimpactinvestors.com to apply.
What do you so you put a bow on 30 some odd years of banking at a single bank at Eldora, right? What took you to that conclusion, and then what's next?
We'll discuss the conclusion of the banking career was I'm old. I'm not, but it was the perfect time. I was sitting there in Eldora, Iowa, with a bank that had the vision to, look nationwide, gave me the latitude to go nationwide. And there was always a fear that, I was going to walk out the front door to go to the courthouse and get run over by a grain truck. And there was, we had customers all over the country that they probably couldn't have found, if they needed to come to the bank in person, they probably couldn't have found Eldora, Iowa. Short story, we found a young person, younger loan officer, very well suited, experienced to take over my position and continue doing, which isn't easy to do, to find an experienced commercial lender to base out of a town of 3,000 people and, travel the Midwest. So the door was open and I walked out.
Yeah.
Then I interviewed him. I said, "Yep, you'll do. Here's the keys, kid." But as you and I know, I'm not dead.
No,
I get a little bored sometimes.
I'm laughing because I think it was more like a 6 to 9 month transition to walk out, in and out of that door. That was not a fast transition.
No, it was not. It was about a little over 9 months.
All right, you're looking forward to the next year, 2026. What are you most excited about?
Right now, I'm not. I'm not exuberant. I'm rational, but I'm not exuberant. I'm concerned about some things, but I think there's always opportunity. In adversity, there is opportunity. There's always opportunity. I think that probably, long term, I think the housing market, I think there's going to be some adjustment. But as we were talking, I haven't, interest rates are down, we're down I had actually heard somebody got quoted 4.98 on a 15-year.
Wow. Yeah.
Don't know that's true, but I was told that someone got quoted just under, but under 5 on a 15.
Yep.
So I don't know where we are on the affordability index, but 30-year, the national is still over 6, but we're in the 5s in the Des Moines market. So I think we'll see some returning strength in the real estate market.
To comment on what you just said, I just looked up here the other day. The Atlanta Fed puts out the affordability index for single family housing. It's obviously a combination of factors, really being what's the median house price, what's the median income, and then what's your average interest rate on the 30-year. And then I think they estimate 10 or 15% down payment on the thing. They indicate anything above 30% is largely unaffordable, right? Anything below 30% of one's income here is affordable. And I think even their most recent report, it was somewhere in like 36 to 37. And I think when I ran the numbers, given some reduction in interest rate compared to what they had, I was still coming up at 34 and change. Still labeled as unaffordable.
There are still, yes, we still have some obstacles to overcome. And that's, I'm saying, and going back to what I said before, it's just staying steady, staying focused, slow and steady. I don't see a bandwagon coming down the street. If it does, I'm not jumping on it. But I think there will be opportunity in housing. And I think part of that's going to probably be because I'm not sure how this all plays out. Housing prices, that affordability index, one way or other, whether it's the price of the house, the interest rate, or the income, that has to adjust.
Oh, it won't be income. I mean, income in nominal numbers or in real numbers has barely moved over the course of 50 years.
Oh, yeah. You look
in real numbers. In nominal numbers, it certainly has. But in real numbers, yeah.
I think the magic year, you can go back and check that, I think is 73. That's a big question for economists. What happened in 1973? And you look at the graph of employment and wages and purchasing power, and it's actually only has it not changed, it's gone down.
Right. Right. Which reduces you down to two single factors: housing prices and interest rates.
And it's going to be, I was talking to somebody else yesterday, it's going to be difficult to get the price of housing down, especially when we'll see what happens with the tariffs. For a while, the cost of housing has accelerated because of two things. It is demand driven, but it's also systematic that we have gone from COVID to supply chains to wildfires and lumber shortages in the United States and Canada to now tariffs. And that's a lot more difficult type of inflation to deal with. You can't snap your fingers and restore 15,000 acres of old growth timber. You know, you can cut the interest rates. That's not going to do anything with what's happened to the supply chain, COVID through everything. There's still problems that haven't all been solved, and then you put tariffs on top of that, and there's not much you can do.
Yeah, the idea where you're going is that new construction pricing cannot come down.
It's going to be very, very difficult, and that's the conundrum. I remember, like I said, I got started in real estate very, very young, and I remember the first house I sold. I was a freshman in high school, and I got to go with Dad, and he let me do it.
Yeah.
It was the football coach, and then come to town a year before that, he was the football coach, the driver's ed teacher, the health teacher, and the athletic director, and his wife was a nurse at the hospital 20 miles over. I think between the two of them, they probably made $40,000 a year.
Yeah.
And this was 1976. They bought a nice little 5-year-old 3-bedroom, 1,350 square foot ranch house for 36.8. They're sold in that house for 36.8. So where are you going to find a teacher and a nurse whose combined annual income is equal to the price of the house? That's a $425,000 house now, and the people who are living in it ain't making $425,000.
No, yeah, I would argue they're not making half of that.
Right.
Yeah, it looks very different today.
It's a new ball game. It's a different set of parameters, and I'm not sure. I'm just sitting back and watching and saying, where's the opportunity for me, Neil, and the people that we deal with, that we advise, that we finance? I won't say vulture, but I'm just sitting back watching to see how far up the ladder I have to go to get some decent fruit. And I'm not a big fan of heights. I like low-hanging fruit.
Take me out of housing, out of the single family side, out of the multifamily side. Do you see this playing out, or are you looking at this differently in other asset classes?
It's not one size fits all, but there's always, a rising tide elevates all ships, but there's also cross contamination. So I think that as we have seen in the last 2 to 3 years, but I would say especially since the end of 22, that there's opportunity in commercial, whether it's warehousing, flex. Flex has been good. When you've got a building that can do anything from, we can bring in the welders and start doing small manufacturing, or, we're gonna be a distributor, a wholesale distributor. Those buildings have been popular, but because of flexibility, you always have to have an alternate plan B. But I think that there will continue to be in storage, light manufacturing, processing, professional office space, clinics. I think we'll see more and more of the small medical clinics. I think the quick stop of your daily clinic. I think we'll see more of that. I think we'll probably see more there'll be more chain type. We've already got Aspen Dental and 24-hour glasses, but I think we'll see more of that, and I think you'll see the Mercy hospitals of the world, who probably won't be Mercy. Somebody's going to buy that in 5 years.
Right.
Everybody. There'll continue to be consolidation and things like that, which will bring opportunities. You as a landlord will have the opportunity to build. I just did this. It was one bay, one suite out of a 4-unit in a suburb just out north of Dallas, was Southwestern Medical University's prompt care, 1,120 square foot or something. A doctor, a couple of PAs, a few nurses, and a receptionist. We're not building big clinics
Nope.
the way
Right.
we used to, but you and I can't afford to finance a clinic. But they now, as you know, SMU would have built that whole, if they were going to build a practitioner clinic on the corner of, wherever, downtown or whatever. Well, now we just go out into the suburbs and we rent a building. Literally, it was next to Jersey Mike's, then between Ensalada and Jersey Mike's.
Yeah.
Well, there's a guy that put up a 4 suite building. It's with the cost is within the grasp of your average developer, and there's an opportunity if you look to that type of thing. And what better to have anchor your 4-door building on than the quick care, the prompt care.
Yeah, the medical places. Certainly that profession has changed with their real estate footprints and how they serve clients today versus some number of years ago.
And like I said, whether it's, we're seeing changes in restaurants and preferences, the delivery of products and services is going to change. It continues to evolve.
Naturally.
And I think that's where you just got to sit back and be the fly on the wall, watch, be observant. You ask about what is one of the qualities of a successful investor, developer. Curiosity. I mean, that you've got to be in front of the trend. And no one has, as we said, no one has crystal balls. Curiosity and innovation is what drives invention and success. We've got to be in it. We can't survive by the same business model that we did when I really started pushing into commercial real estate in 1997, 1998. Can't survive the way we did then.
No, the world looked very different back then. Certainly the way you underwrote deals, the way deals were financed, pre 2008 was very different than how you'd finance, how banks are regulated today, and what they even can do if they wanted to do it.
Oh, I mean, when I look back at what we considered, and again, this goes to the inflation of price, because your cash flow coverage is a function of your debt, and your debt's a function of your price. But what we looked at as reasonable LTVs and cash flow margins on office buildings and apartment buildings in 2005 versus 2025, and you and I have talked about that. There was a time if you could find an apartment building and, I can get by with 20, maybe even 15% down, probably make this work. Sorry, Charlie, that ain't happening now.
No.
You and I both know you're looking at probably 30% down to make a project work.
To make it work. A lot of that
has almost doubled in the last 10 to 15 years.
Yep. Beer, barbecue, and networking. Well, it's a recipe for a good time, and that's exactly what we've got lined up for our second annual Investor Tailgate on October the 10th from 4 to 6 o'clock. I'm hosting it right here for local investors, and you are invited. There's no agenda. There's no speeches. It's just a relaxed evening to hang out, make some connections. Of course, enjoy some dinner and drinks on me. Now, we had such a blast last year that we had to bring it back. Now, here's the deal. I need to know how much food and drinks to order, so we got it ready for you. So do me a favor, RSVP for me at littleguyloans.com/investor tailgate. That's littleguyloans.com/investor tailgate. It's going to be a fun night. You never know who you might meet. Could be your next partner, could be a great contractor, could be a new friend in business. Don't miss it. I'll see you then. So one of the things we just announced here a couple of days ago was that you have joined Little Guy Loans here, our firm, as the commercial lending partner. What is?
I have.
Yeah. So, and I know that sounds self-serving, given that's my firm. I know it sounds self-serving to get you on the podcast. It only took me a year of doing this to get you on the podcast. I know we always kept talking about it, and then you announced your retirement, and we're both like, well, maybe not now. And then 6 months into your retirement, or maybe longer, 9 months into your retirement, I convinced you that maybe you're a little more bored than you thought, and maybe there was something that we could do together. So, what does, for the audience's sake, what does it even look like? We've talked about a little here, but at Little Guy Loans, we do hard money lending traditionally for house flippers, for guys who need short term money to reposition property to flip or to turn into rental property. And now, with you on board, we're expanding that to all commercial assets all across Iowa.
Right. It's got a foundation and a roof,
Mm-hmm.
and both of which have to be sound.
That's right.
And solid. You and I have, I said you have to be observant, and you have to be an innovator, and I think that's, kind of where we're going with this is with Little Guy Loans on the residential side. You saw a different opportunity and came and asked me, "Hey, what do you think?" And I think it's an opportunity for everybody that we can probably do some things that, having been a banker in one way, shape, or form for 40 years, there are things, and I know we've joked about this, a lot of bankers, you got your banker's box and it's got 90-degree corners. And my joke always was, well, I'll put it in a hefty steel sack, and if I can tie the strings, turn it upside down and nothing falls out, we're good to go. And I don't like to be process or transaction driven. I've spent 40 years of my life, 10 riding around watching my father and his peers, and then 40 directly involved of being a relationship banker, a community banker. When you're a community banker, if you don't have a strong community, there's not a whole lot of need for your existence.
That's right.
So, and I've just come to, over the years, expand my definition and boundaries of my community. When I started doing business in Waterloo and Cedar Rapids and Des Moines, I was like, well, here's my community. It's just bigger now. So I think it's an opportunity to bring a different perspective into and offer a new product that's just natural. If you're doing it on residential, you can do it in commercial. The difference is residential's flipping. We know you're going to be out of that in 6 months. This is going to be probably 1 to 3 years, giving people the opportunity. You talk about the banker's back box with the 490-degree corners. There are, it's like each one of those corners has a check mark. There are borrowers out there that are missing one of those check marks, but that doesn't mean it's a bad loan. That means that people have to realize that banks are highly regulated. Right?
Yes.
There's a big section of the Iowa Code that has to do with banking, and it dictates the information we collect, the maximum loan to values, what type of appraisers we can and cannot use. You and I, as Little Guy Loans, are not bankers. And sometimes it's just common sense to say, well, we don't need that box checked. And
That's right.
We don't have a regulator looking over our heads, looking at that checklist. I think, it becomes very frustrating. And that's probably one of the things that made me say, well, I may retire a little earlier than I thought. The checklist processing mentality that just is pervasive, but becomes a problem because there are things that, it's not one size fits all. There are things in banking code and banking regulation requirements and this and that it's practical here, but it's not here. And we can get around those things.
Yeah. The intent is to make common sense when not every, we got to hit some check marks, certainly we've got to process, but the intent is to do what banks don't do. It's not to compete against banks. It's actually to be a complement to banks and banker, all the friends that you and I have in the banking world, because to do what it is that they cannot do. And then the intent is, cool, somebody gets to reposition a property. If they sell it, great. If they want to refinance it, fantastic. In 1 to 3 years, they should be repositioned to go to a bank.
Exactly.
Refinance out of that.
I think one of the things that always benefited me and allowed me to be successful in 40 years of banking was common sense. I look at the opportunity to bring that common sense approach into a new level or a new arena of lending. And just like you said, getting people over that hump, that speed bump of I'm one checkbox away from qualifying for a bank. But you and I, with common sense and relationship, gold lending, not transactions, one off, can figure out how to get over that speed bump. And just like you said, the goal is that in 2 or 3 years, we do a loan now, on 2 and 3 years, they're gonna be able to check all those boxes, walk into First Bank and Trust of, wherever, lay their file, their portfolio on the desk, and the bank's going to go, oh yeah, you got all your boxes checked. Let's do this one.
Yeah, no, you're totally right. You and I've known each other, and I actually looked it up the other day. 7 years. That's how long it's been since how long we've known each other. And I borrowed a lot of money from you over the years. One of the things I always valued about our relationship is that probably a lot of credit to your bank too. I suspect they gave you the latitude, but one of them is that you always acted like a consultant. Like, hey, we're in this together. I am your partner, and you took on that role, that responsibility. I know when I talk to other people around town, I get the same feedback, and I suspect that the bank gave you some latitude to go, hey, we're going to give you some signing authority. You're going to be able to say yes or no to people to actually make some loans and some decisions versus go gather all the information and bring it back and then, tell everybody yes, get them, get them hooked on the line, and then loan committee will tell you what you're actually going to do, and you got to go back and fix that problem or mend that relationship if you can.
Well, yes, I said I would have been extremely fortunate. Ownership of the bank had a vision that exceeded the size of their bank and their market, and I got a lot of latitude. I was the loan officer, underwriter, credit analyst, all in one, and was able to do that. And they realize it, and that's the other thing is if we look at what adding this new room on our little guy loans house, you got to be different.
That's right.
Everybody's money's green. That's what I'm a loan officer. That means nothing more than I'm selling money. I'm a glorified gas station attendant. I'm not selling gas. I'm selling money, and it's green just like everybody else's.
Yep.
You got to be different. And the best way to be different is through relationships and service. And that's something, I said I was riding shotgun with my dad by the time I was 4, maybe even 3, and that's 59 Mercury. It beat it into my head, and I watched it for all those years and working with different banks. We mentioned doing some participations and looking at philosophies, and if you treat people like you have a genuine interest in them, which I do, then all of a sudden we're on a different level. It's not just me selling you money. It's me taking an active interest in your business.
I suspect that there aren't many people from a town the size of Eldora who've lent over $1 billion in their career.
Probably not.
You're being hats off. You did say that earlier. That's a point of success. Be humble. So you eat your own cooking. Probably not. That's kind.
No. And if they did, it was probably my boss. No. I very, very fortunate to have had the opportunities that that bank afforded.
You ready for the final 3 questions?
I am.
If you were 20 years old, if you go back to being 20, what advice would you give to yourself?
Be an electrician. No, I would say I followed my own advice to some degree, was that slow down, that contrary to what people tell you, that you have to have your MBA and life figured out by the time you're 25. No, you don't. I would say that education is really, 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 really valuable. And then you got to be able to apply it. So I think that is, don't let other people set your norms here. And I've never played well with others. I've always been just a wee bit independent. So I didn't follow tradition. I started at the University of Illinois right out of high school. Didn't like it. went back to the farm, worked with Dad in the real estate business, got involved in the local bank that we were involved in, went back to school when I was 27. So, and by the time I went back to school, I had spent, all these years hanging around with some pretty smart people. I knew when you started, when you opened the book on internal rate of return, I knew where that was going to be useful to me the day I started reading that chapter.
Yep.
Whereas when you're 20 and your finance professor says, "Oh, we're going to learn about internal rate of return. It's how investors decide how they prioritize projects and the use of their capital." What?
Right.
Yeah. So for me, that was, and I think a lot of people are that way. Find your own path.
2 books that changed your life.
Boy, that's probably The Hunt for the Bismarck. There, I would say probably, I can't think of not because I'm a disciple or devotee, but Machiavelli, The Prince.
If you were cast away on an island for a year, you could only get 3 pieces of data about your business each and every month. What 3 things must you know every month to know how your business is running? And I'm going to let you can choose to wear any hat to give that answer. Banker hat, an investor hat. I'll let you. Dealer's choice.
No, I need three pieces of information. I need sales. I need expenses, which is gonna give me profit. So I don't. Nobody has to tell me that. And I need margin. That used to be the screensaver on my computer 30 years ago because things were early 90s. There was a little go-go movement. There was some optimism and some things, and my screensaver, because I like to poke people and knock them down a peg or two every once in a while. My screensaver on my computer at my desk, which I would every time I got up, the monitor to the size of a Toyota, I'd swing it around. Said gross means nothing, margin is life. Well, gross sales mean nothing. Margin. That's what I want to know. I want to know my income. I want to know my expenses. I want to know my margin. And if you can give me that, you can give me a pina colada and the entire box set of Led Zeppelin, and I could run that business from that island. And
I asked lots of questions. What's one question I did not ask that I should have asked?
Well, I think one way or another we covered just about everything, and I think down to the basics. Is as we get into this new venture with Will Guy, what does the borrower need to bring to us? But most of these borrowers are not going to be their first trip down the road.
That's right.
It'll be pretty much the same as a banking loan process, and we can provide that. And that probably wouldn't be the best use of the time we had in this forum.
No, I think it. What do they need to? What do they need to provide, Larry? I think the best place to start is a phone call or a connection with you, and it all starts as you have perfectly articulated through our whole conversation. Starts with a relationship.
It does, and that's what one of those nuggets of wisdom as you build that relationship is that it's joint, and you can say no 1,000 times. You only get to say yes once. So we work together that we say the no is a joint decision and the yes is a joint decision. It's got to be work for both parties. And I think that's probably one of the things that probably alienates or is misunderstood when someone goes into a bank and gets declined. Not because I don't like you. It's not because I think you're stupid. I think it's not in our joint best interest to do that project as proposed. And if I didn't explain that, then it's my fault. If you walk out the door feeling anything else, then I'm interested in you and your business. And this isn't an acceptable, the risk tolerance and the reward doesn't make sense to me. That's what it's about. It's not a slap in the face. No, it's an arm around your shoulder saying, let's step back. Let's step back and take another.
For people who want to find you, follow you, connect with you, I'll be certain to drop your email address below in the show notes. But past that, any other way to get in touch with you? Cell phone. I'll put that in the show notes below as well. You want to give it out here?
I sure can.
Go for it.
751-2263.
Larry, I appreciate you being here.
Appreciate you, sir. Always have, always will.
See you soon.
Thank you.
Hey, quick reminder, our investor tailgate is October the 10th. beer, barbecue, networking, dinner, drinks. They're on me. There's no agenda. There's no speeches. Just good people having good conversation. RSVP at littleguyloans.com/investor tailgate. So that way I know how much food to order for you. It's at littleguyloans.com/investor tailgate. Don't miss it. Thanks for listening. If you're enjoying the show, may I ask a favor of you? Naturally, subscribe so you never miss an episode. But would you rate and leave an honest written review on Apple Podcasts? It does a lot for us here at the show, and I appreciate reading your thoughts. Great guests make for a great show. If you know of another Iowan who would be a great guest, or you yourself have interest in being a guest, well, get on our radar. Visit Investing in Iowa to fill out an application or recommend a guest. And if you want to connect with me one-on-one, go to LegacyImpactInvestors.com. Click on the Invest With Us button in the top right corner, and there you can pick a time for the two of us to get on the calendar and connect. Until next time, keep investing in Iowa.